Hey everyone, earnings season has officially kicked off, and in this video, I'm going to go through this crazy week of earnings that we have on our hands. I'm going to go day by day talking about some of the companies that I'm really looking forward to their earnings reports, going to look at their earnings per share estimates, some more information about these companies, and then just talk about my overall thoughts on what investors are going to be looking for in these companies and what I think about their current valuation. So we're going to get into this one in a second. But before that, if you don't mind, if you like this kind of content, be sure to give this video a big thumbs up. And I haven't done a earnings summary video in a while. So if you do like this kind of content, be sure to let me know in the comments as well so I do them more frequently. So we're going to start on Monday here. Monday has already passed. It was today. So on Monday, the only name that I was personally interested in was Charles Schwab. So we're going to look into Charles Schwab. Charles Schwab here had a really good reaction to their earnings. The stock is up over 4.5% here today. So initially, I thought, hey, like they must have had a great earnings report versus last year, but they actually had pretty broad declines versus last year. So you can get the sense that they just had really low expectations going in. I think one of the issues with this business is lots of consumers and customers are having a lot less cash on hand in these accounts that they were making net interest margin on, because the cost or opportunity cost of holding cash in an account has gone up exponentially with interest rates where they are. More people are putting money in high interest accounts or treasury bills or GICs or what have you. So I think that probably was one of the factors, but it still seems like they beat analyst expectations. Looking at some of the sentiment around their earnings report here, you can see here they did 77 cents a share versus 74 cents that was expected. Still significantly down from the $1.10 last year. So I think it's just expectation setting, and that's why the stock kind of skyrocketed here today. Longer term, you can see the stock's down 20% on the year. And the reason I'm actually interested in this name is because I own TD Bank in a pretty big way, and they own a percentage of this company through the TD Ameritrade merger with them. So that's why I'm interested in Charles Schwab. Looking at the price to earnings here, on a forward-looking basis here, we have a 4 EPS next year. So that puts it at about a 13 times multiple. You know, I feel like that's more or less in line with the broader US financial sector. So probably a fair spot to be at this rate. And overall, I guess it was nice to see the stock jump a bit on the earnings. I don't own it directly. So it was just interesting to see how far year over year performance has dropped on some of these financial names just in the brokerage space because of the deposits or lack thereof. On to Tuesday, we really have a lot of companies reporting on Tuesday. A couple of them that I'm personally interested in. Goldman Sachs is always interesting, and specifically on their investment banking division. In addition to that, J&J has been making a lot of moves on their business. They offloaded their consumer business, so really want to hear how much of those positions they've sold to the public as part of that move. And in addition to that, Lockheed Martin, obviously tons going on in the world in the defense space. I've never really invested in that space, but I think it's just an interesting one to keep mind of and see what their outlook is for the global economy and how they kind of position themselves in that with all the issues going on in the world right now, unfortunately. Okay, going into some of these earnings for tomorrow. So Lockheed Martin, you can see here, has jumped a bit in the last month. They had that one big jump here from just under 400 up 10% on the news of the recent war that's going on. But longer term, we've seen it kind of wane off, down 10% in the last 6 months, down 8% year to date. Longer term, still doing okay, up 35% in the last 5 years. You get a nice 3% dividend yield as well. Looking at their EPS on this one, expected to do about $28 a share. Next year, it did $27 this year. So I was actually surprised to see that this was so flat. I thought with all the issues going on in the world and the current issues that we came going into this year still persisting throughout the year, I thought that the outlook for next year would be significantly higher. So that was actually a bit of a surprise to me. But all in all, the stock's trading at about a 15, 16 times multiple, so not overly expensive as well in this name. So I found that to be interesting. The next one here, Goldman. Goldman trading at just over $300 a share, $100 billion market cap here. You're actually getting a pretty good yield for Goldman here at 3.5%. Usually the U.S. financial stocks, I feel like, trade a bit cheaper or lower yielding than 3.5%. So that was interesting on that one. Going into their earnings per share. So they're expecting a huge increase, $24 this year, $35 next year. So that's like a 40% increase in EPS. So not sure how much I buy that, how much I actually think that's going to happen. But if it does, and that's the average analyst estimate, they're going to be trading at about 9 times at the current earnings projections for next year. So we'll see how that pans out. It's one that I'm not really overly interested in, but I do like the just the content that they spew out with their earnings report in terms of how they see the U.S. economy, how investment banking is doing, how M&A is doing, more so stuff like that than actual information about their particular company. Okay, going into Johnson & Johnson, this is one that I'm really excited for tomorrow or probably today by the time you're watching this video. The dividend yield's just over 3%, so a decently nice starting dividend yield for a company like J&J. Massive company overall, obviously. You can see here it's kind of stagnated over the last year. They've had a lot of legal complications, some lawsuits on some consumer products, and they've also had a lot of restructuring. So they actually spun out their consumer division. It's called Kenvue now. You can invest in it in isolation. They own like J&J baby powder. They own brands like Band-Aid, Listerine mouthwash, stuff like that. And they actually announced here, which was a bit surprising, that they only plan on keeping about a 10% stake in that spinoff. I would have assumed they would be a 50, 60, 70% shareholder. They just didn't want to manage it directly with the company and then maybe weighing that down over time. But they're pretty much done with it. They just want a tiny piece. And at some point, they may even just drop this 9.5% and go full into the pharmaceutical and the medical device business, which is where they're clearly focusing on. Their EPS estimate is about $11 for next year, $10 for this year. So this company does not trade that expensive at all. At $11, they're trading at about a 14 and change times multiple to next year earnings. You're getting a 3% dividend yield. And this is a dividend king that's increased their dividend in like 50 plus years. So really interesting entry point, especially if you want some healthcare exposure on the medical device side in this name. Okay, going on to Wednesday. Wednesday's probably the craziest day of the week, one of the craziest days of this earnings cycle likely. In the morning, you got Procter & Gamble reporting, you got Morgan Stanley reporting, Abbott reporting, a bunch of other banks, NASDAQ, Ally, First Horizon, which is another one that TD actually tried acquiring earlier this year. So the ones I'm looking forward to in the morning are primarily P&G, but in the afternoon, there's a ton more. You got Tesla, Netflix. These are like can't miss earnings reports. Even if you're not invested in the names, they just move markets. Netflix usually moves the entire media sector depending on what they say in their earnings reports and what numbers they post. Tesla, huge market cap, $800 billion. So those are ones I'm going to be looking at. In addition to that, Las Vegas Sands is one that I just find interesting in the entertainment space as well. Got a bunch of other names that I'm not overly interested in, like Discover Card and whatnot, some other banks. But those are really the three that I'm going to be looking at. So we're going to start here with Netflix. Netflix is has been an interesting stock. You see over the last year, up huge, up almost 50%. But with that being said, they've actually experienced a bit of a tailing off. You can see here they were up at about $450 to $500 a share almost. And now they're all the way back down to $360. So they've sold off a bit. As we look into some of the reasons why, you can see lots of analysts have kind of reset their expectations on the media sector as a whole. We've seen stocks like Disney, Warner Brothers Discovery just get hammered. Yes, on linear TV, but also I think just the lack of the lack of growth from a user standpoint on streaming has probably caught up to the sector at large. So it'll be really interesting to see a couple things on Netflix. One, if they're able to get a really good total subscriber growth number. You can see here at the end of the last quarter, they're at about 240 million global paid subs. So does that grow? And then secondly, with the advertising option, is their average revenue per user going to accelerate at a strong rate that makes it worth it to do and gives investors that story on, hey, even if we're stuck at this 240, 250 million total subscriber spot, are we able to drive more profitability through more revenue via advertising? Is that a model for success that is becoming more and more evident for streaming companies? So I think that's what investors are going to be looking for. In terms of the EPS on this one, going to do about $15 next year, so trading at about 24 times next year's earnings. Looking at this year, they're closer to about 30 times this year's earnings. So pretty expensive on this year, but they expect to grow pretty quickly here, going from $12 to $15, about 20% plus EPS growth. So when looking at next year, it really doesn't look too unreasonable, especially when taking into consideration kind of the growth history of Netflix here. So this is one that I'll definitely be keeping an eye on. I'll probably even listen to the call just to better understand what numbers they are putting up and how they kind of see the space moving forward. I do not own Netflix stock currently. The only stock in the media space I own at all is Disney, and it has been one of my worst performing stocks. So we'll see how it goes this time around. Next one up here is Tesla. Similar to Netflix, or even more pronounced, Tesla has been flying up almost 150% year to date. We look at the last 1 year though, and it's just up 15%. So that just reeks of volatility. You can see the stock went all the way down to $100 here at the beginning of the year. Huge ups and downs, up to 300, now down to 250. So it's gone down about 15%. One of the main reasons why the stock's been trending down recently is they actually posted relatively weak delivery numbers versus analyst expectations. They had about a 430 and change deliveries this last quarter and production. And I saw some analyst expectations all the way up to closer to 500,000. So on that, they had a pretty big miss. You see here, they cited about 461,000 was what they cited as the Wall Street expectations in general. But I saw anywhere from 460 to 500. So let's call it a 10% miss on deliveries and production, which is part of the reason why the stock's kind of traded down to that 250 range. In terms of EPS, going to do about $3.30 this year, about 20 to 30% growth to $4.30 next year. On $4.30, the stock trades at, about a 50 to 60 times forward PE. That's a bit less than the 70 to 80 times PE they're currently trading at, but still like extremely expensive. So you're really still buying the future story on Tesla if you're buying shares here, what they're going to do in autonomous driving, what they're going to do on the energy side of things, what they're going to do in terms of continued push on EV and market share in the broader car sector. So not one that I've ever owned or is close enough to me wanting to own it from a valuation perspective, but that's just because I prefer to minimize the speculation in my portfolio. Yes, this may have much higher returns if they hit on all cylinders, but I could also see a lot of correction in terms of P to E, PE ratio in the short to medium term. So this is one that I'm staying away from, but I also really enjoy seeing what the kind of numbers they put up, seeing how the stock reacts, and the innovation in this company is great. Going on to the next stock on Wednesday that I'll be looking at, P&G here, $146 a share. You got 2.6% starting dividend yield, and similar to J&J, they've increased it for 50 years plus. Current trailing PEs at about a 24 times. One thing that's interesting to watch on this company is they've been hiking prices a lot. And one thing that we saw from this company, but also other companies like it, like PepsiCo, etc., they've been successful in taking price increases, but they've started to lose volume. So just because your sales maintain flat or your sales slightly go up doesn't necessarily mean that it's sustainable to continue to do it quarter over quarter over quarter. So it'll be really interesting to see if this company is able to one, continue to take pricing and make sure they're protecting their margins, but doing it in a way that they still have strong unit fundamentals and unit growth, or at least flat units in the market across the company here. So looking at their EPS, going to do about $6.40 this year, so trading at about 24 times multiple. Looking at next year, closer to $7, so closer to a 21, 22 times multiple for next year. That's on the cheaper end of where these stocks have traded, which has been anywhere from 24, 25 upwards to 27, 28 times multiples. But I think the lower price to earnings ratio is warranted given where interest rates are right now and where broader earnings ratios and P to E's have gone in the last few months. So I think these companies are probably fairly valued. I'm kind of slotting J&J, P&G, some of these other ones in the same bucket here. In the afternoon on Wednesday, the last one I kind of wanted to talk was Las Vegas Sands. So based off their name, you'd think this company is mostly Las Vegas. That is not the case anymore. This company owns a ton of real estate in Macau. And you can see here in the last year, they've been on quite a ride too. Started at about $30, went all the way up to 60, now down at 45. So lots of volatility in this space. Looking at their Macau exposure here, you can see how huge their business is here. About $15 billion invested, 30 million square feet on the main strip in Macau here. They have retail, they have entertainment, they have convention centers. They're looking at continued expansion here, okay? $15 billion of investment, and the total market cap is about $35 billion here. So you can just get a sense of how huge Macau is for them. They still have assets in Las Vegas, I believe, but despite being called Las Vegas Sands, they are really just a broad gambling company with a lot of exposure to Macau. They have some other properties too that they showcase here in terms of some of the expansions they're working on, some really great assets and design. They own a lot of land as well that they're looking at actioning behind. This is some more renderings that they're sharing here. I think this is probably in Macau as well. So, Singapore. So you can kind of get a sense they're really pushing away from Las Vegas, may eventually change their name. In terms of their earnings per share here, did $2 this year, expecting to do $3 next year. So next year, they're trading about 15 times earnings. Personally, in this sector here, let's just look at the long term. Like these sectors are almost like uninvestable for me, just because of how over the very long term, they really haven't delivered a ton of shareholder value. In the short term, they can. If you cyclically bet it right, you can see here from 05 to 07 there, stock went up 300% before going down 90%, before going up 1,000%. It's just so all over the place. And over the long term, it hasn't really proven to be a great equity to hold. So it's a space that I don't really invest in for the most part, but I always find it to be an interesting space in entertainment. You get a good sense of the consumer as well in the United States, especially in China with Macau. So I still feel like their earnings are worthwhile to take a peek at. Going into Thursday now. So on Thursday, we also have a handful of interesting earnings reports. We got AT&T before the bell, which is a stock that I actually own. American Airlines, which will be an interesting one as well. Then you got some railroads. You have Union Pacific before the bell. You have CSX after the bell. CSX is an interesting company to me. I've followed it for a while. I've never bought it, but that's one that I want to look into. And then Intuitive Surgical is another one that I put on my watch list a while ago. I haven't done any real work on it, but I just want to get a sense of their report too if I get the time. So looking into some of those names here, starting with AT&T. So AT&T forecasted about $16 billion of free cash flow this year. In the first half of the year, I think they delivered $5 billion. So they need to deliver $11 billion of free cash flow in the next 2 quarters to hit their forecast. And I think part of the reason the stocks traded down throughout the year has been because lots of investors are kind of clouding doubt on their ability to actually hit that number. If they hit $16 billion of free cash flow, on the year. Stock's trading at about 6 times free cash flow, which in my opinion, on just a net present value of the company's assets and their ability to produce cash flow, is pretty cheap. So that's why I'm investing in it. I'm kind of assuming they're going to hit that 16 or close to that $16 billion. But this is really a make or break quarter for that. If they're unable to put up a serious number, 4 billion, 5 billion, 6 billion in this quarter, I do not see how they're going to pull out all of this free cash flow just in Q4. Let's just say they do 2 billion in free cash flow. That puts them to 6.5 on the year. I don't see how a company is going to turn out $10 billion of free cash flow in one quarter. So they really need to show up with a big free cash flow number. And I think if they do, the stock will react positively. But in the meantime, getting a 7.7% dividend yield, looking at the EPS here, it's pretty in line with the funds from operations estimate. So right around $2.50 a share, trading at about 6 times earnings here. I just think it's too cheap. I get it's not a growth company. I get they have some fundamental existential risks in terms of the cable division, but their wireless division and some of their other divisions are still doing really well. So I think overall the company's just trading at too cheap of a valuation, and that's why I personally own that one. Intuitive Surgical, this is one that is in an interesting space. I was looking at a company called InMode previously, and Intuitive Surgical seemed like it was just a much larger version of that company in terms of the types of products they have here, up 44% on the year. So the rise of this company has been what's kind of scared me away from it, but it has dipped a bit here recently. So I'm just going to take a peek at what their earnings come out as. I'll probably just read the press release, not listen to the earnings report. You see here really strong growth, 550 this year, 650 next year. So that's about 20% growth expected at 650. The company's still expensive. It's probably in a price to earnings in the 40s off the top of my head, in terms of trading at 275 here and doing 650 per share. So really expensive company on that one. And then on CSX, so the railway stock in the last month here and last 6 months, holding up pretty well, pretty much just flatlining on the year. That's pretty standard for lots of the railroad companies. Overall, $63 billion valuation. These companies tend to buy back lots of their own share. So I actually don't mind if a company trades down or has a lower PE in the railroad space, because over the long term, it's enabling long-term shareholders to compound their wealth faster, because you're buying back shares in the company at lower rates, enabling you to buy back even more shares, which enables more of the free cash flow per share to go to the existing shareholders over time. So currently just paying a 1.4% dividend yield, trading at a pretty reasonable 15 times price to earnings ratio. In terms of where they operate here, you can see they're kind of on this east side of the U.S. They look like they're trying to expand in the more central areas of the U.S., but overall really solid network and railway business here. In terms of what they're expecting to do, similar numbers here, nothing too sexy in the railroad space. $2 of EPS next year expected, which is about 15 to 16 times multiple on earnings, which I think is fair for a company like this that operates throughout the U.S. Really decent quality railroad here, trading in the mid-teens. I think it's if anything, a pretty good price. It wouldn't shock me if this one should be trading it more in the high teens, 17 and a half, versus this 15 and change here. And that takes us to Friday. So Friday, the only stock I'm really interested in is Amex. So American Express is a really unique credit card provider. Unlike MasterCard or Visa, they don't really tie into the banking system as much. They kind of have their own network and run their own network. They offer cards for different types of consumers, more premium cards, more affluent cards, more business cards. I personally own Visa right now, but Amex has always caught my eye just because of the valuation of it. They still have really solid business. They still operate in a very similar spot. Looking at the company here, up just 4% on the year, trading at about a 15.5 times multiple. If we look forward looking, they're expected to do $12 EPS next year. So they're trading at like 13 times next year's earnings, whereas Visa is more than double that or about double that. I love Visa. I love the business. I love how mass consumer it is. I love their network of networks and how they tie into the banks because I think that enhances their moat. But at the end of the day, Amex is trading, in my opinion, at a really, really attractive valuation. And that's one of the reasons why I just kind of keep tabs of it, keep watching it, because eventually it may just get too enticing not to jump in to the company. So that's kind of the earnings review or the earnings profile for the week coming up. We have another big week next week, but first, lots of stuff going on this week. Kind of the highlights, just to summarize: J&J on Tuesday, followed by P&G, Tesla, Netflix on Wednesday. Then on Thursday, lots of investors hold AT&T, and then also some railway numbers too between Union Pacific, CSX, and then wrapping the week up on Friday with the first credit card earnings report behind Amex. So really exciting week. Let me know in the comments if you like this kind of content. I tend to not do these earnings reviews too often, but if you guys want me to, I can do them a lot more. In addition to that, let me know what stocks you're watching this week. And if you haven't yet, be sure to give this video a big thumbs up. It really helps get these videos out to more people. And also consider subscribing to the channel if you haven't already. Thank you guys so much, and I'll see you guys in the next one.